Okay, well, we might get started. We've got more than half of those that have registered so far already in, so we'll get started today. Welcome everyone. Thanks very much for joining us on what we believe is a really interesting topic to talk about: transfer pricing and COVID. Certainly a word that we've heard a lot over the last 12 months. Who would have thought 12 months ago, I think we had those the corona memes going around with the corona beer, and it was all a bit of a joke, and here we are 12 months later with everything that's gone on and what we've seen going on in the world around coronavirus and the impact that it's had on so many of us in just the past 12 months. So I'm going to go through today a bit about the what's been happening from an OECD and ATO guidance perspective. So just to go through now on the attendees here today, the panelists here today, obviously I've got myself, I've also got Adriana Calderon, who's our director in Singapore, and Kevin Tay, who's also based here in Melbourne office. So they'll be monitoring the questions if anyone does have any questions, and we can address those as we go through, through either during the session or potentially at the end. Just to introduce myself, I think that probably I know half the people already on today, but those of you who are not familiar, I've been working in transfer pricing for well over 25 years, previously Big Four, and set up transfer pricing solutions now just over would be about 15 years ago to specialise on transfer pricing, where we provide transfer pricing services. I guess probably half our clients are directly to the end companies, and half of our clients are to accounting firms to assist them in actually providing transfer pricing services to their clients as well. I'm on the Australian Government's Board of Taxation Advisory Panel and have been renewed every year since 2016. And I also teach transfer pricing at Melbourne University as part of their Masters in International Tax Law. So for those of you who haven't met me before, yeah, thanks for coming along and joining in as well. Just a bit briefly about transfer pricing solutions. One thing that we like to really pride ourselves on is providing practical advice, proactive and cost-effective transfer pricing advice. So really getting that specialised service and really getting something that's practical, not always just the theory around it, and helping you implement it as well, so that you can actually take the transfer pricing ideas, the strategies, and actually make them happen from a debits and credits accounting perspective. Because a lot of people, I guess, when you're dealing with some of these transfer pricing aspects, the transfer pricing structure is never going to work if you can't make it operationally, if it can't be operationally implemented. And having accounting backgrounds as well means that we can talk all the debits and credits with you, which make sure that we can work out for you if there's TP adjustments, what are the debits and credits going to be, how are we going to get those into our books to make sure that you can operationally implement any transfer pricing structures as well. So just looking at transfer pricing solutions, there's a number of you I've been working with for many years. We started in Australia, started in Melbourne. I've been going now around about 15 years in Melbourne. Just over, I think it would be 4 to 5 years ago, we set up in Singapore. Adriana heads up our Singapore office. And just over the last 2 years, we've set up in Malaysia and started to expand in those different locations. So we get to practice transfer pricing on our own business now and have to go through our own TP calculations on a quarterly basis. So I can really understand what companies go through when you actually have to look at your own transfer pricing as well. Just a bit about some of our industry leadership and some of the awards that we've had. We have done very well from an Australian and also international perspective at the Asia Tax Awards, most recently last year in the Australian Accounting Awards. And we're also announced as a Tier 2 transfer pricing advisor. I'd love to be a Tier 1. That's the stretch goal for next year. But when you see all the Tier 1s up there, you'll see that we're really going to have a big stretch goal for this coming year, but really proud to have been a Tier 2 up against a lot of those others that are a Tier 3 and other notable recognition. So what are we going to talk about today? COVID, you know, as I said, a word we've all got used to, and the impact that COVID has had on so many businesses across the world, whether it be on the multinational companies, looking at your supply chains. Now, even when we looked at the supply chain, we've seen the impact on not only the sourcing of the products, but potentially companies are having to look at how they restructure their supply chain to deal with some of the implications that we've seen. We're seeing a lot of closures for periods of town lockdowns. Obviously here in Melbourne, we are well experienced at lockdowns when we thought it was going to be 2 weeks. And I think it ended up being, was it 123 days, if I've got the number correct? And what impact that had on a lot of businesses, especially a lot of multinational companies based here in Australia, but also those that are foreign subsidiaries that were based here in Australia, and the impact that's going to happen. And also the economic stimulus, which I think we can all agree, the JobKeeper and the cash boost was just a great thing to really help a lot of businesses get through what was going to be quite a painful situation. A lot of these different areas had financial impacts for the businesses. And when you have that financial impact, that is going to impact transfer pricing. Now, why do we care about that? Well, actually, it's all the tax authorities that do care about it, because it's really going to come down to what profits do we still have taxable here in Australia, and what profits are potentially taxable overseas, or in a loss situation, where does that loss sit, and potentially then some carry forward losses. So a lot of what we've seen going on, and I know some people have raised issues on, is this going to be similar to the global financial crisis that we've all experienced a number of years ago? I guess there are some elements that are probably a bit similar, and I can see where some of those aspects will come through on the transfer pricing side, but I think we can all agree the GFC was very different to what we're experiencing now going through COVID as well. So I'll start by going through the OECD guidance. This was released timely for our Christmas break, so we could all have some extra reading material. 18th of December, they released, the OECD released this. The ATO did put out a release quite a bit earlier. I'll touch on that towards the end of the presentation, but I'll go through the OECD and some of the issues raised by the OECD guidelines. They've also been addressed by the ATO. So, we will go through a lot of those towards the end as well. So the key thing that we saw coming out of the OECD guidance, and basically the guidance is looking at the transfer pricing implications of COVID-19. What does this mean? A multinational company or a foreign subsidiary here, what do you need to look at, and how is COVID-19 going to impact? Because as I said before, all of these issues that many businesses faced from an operational perspective will have a financial implication, and therefore it will filter down to the transfer pricing. So some of the areas that that's going to touch, and I'll go through these in further detail, is around the comparability analysis, in coming up basically with the numbers, I guess you could say, the comparable numbers. The losses and allocations of COVID-19 specific costs, where does that go? The government assistance programs, and then what do you do with advanced pricing agreements that you've got and arrangements you've already got in place now? So if we touch on first on the comparability side. So when we're looking at comparability, so I talk about in transfer pricing analysis, you're going to almost generally always have this comparability analysis, especially with the rapidly changing market environment that we're seeing now. It's going to be absolutely essential that we get this right to reflect the market conditions that you're experiencing. And as we've seen in Australia during the lockdown and as coming out of the lockdown, we're not only talking potentially market conditions Australia, but you've seen different market conditions within different states, which is not something we've often been looking at in the past. So when I talk about comparability analysis, what I'm talking about, this is what we call the exciting part of transfer pricing. This is looking at the economics. I realize for most of our clients, it's not as exciting for them as it is for us, but this is the process of where we're trying to compare, in a sense, apples with apples. We're trying to look at eliminating any differences that might be variations. And if I go back to my apple analogy, is there going to be a difference in the financial outcomes if I have red apples and green apples? Maybe there's no difference in the financial outcomes. But if I'm trying to compare apples with apples, now that we've had all of this happen from a COVID perspective, how do I compare my company's transactions? So what I'm trying to do, I transact, if I use an example, as a foreign subsidiary here in Australia, I transact with my foreign parent. How do I test and show to the local tax authorities that the transaction between myself and my parent company is at arm's length, and I have comparable data to prove that this is what arm's length parties would do. Now, because of this whole COVID situation, we're going to have changes in not only the financial outcomes of your company, so what we would call the tested party or your company, but also those of your comparable companies that you're going to be looking at. So we are going to need to dig deeper, especially those companies that may have actually fallen into a loss at this time. If I look at them compared to maybe the comparable search that we may have performed the year prior, and whilst we may update it, if I look at it to the prior year, they may not be within that range and at what would normally look at as an arm's length range that they've achieved. So there may be other areas that we need to dig deeper. So I suspect over the next 12 months, performing a comparable search is going to require not only the search that we do in the database, but it's going to require a lot more groundwork. We're going to be coming back to you to say, can you please give us advice as to how did COVID impact your company? I might even be wanting to have a look at your financials on a monthly basis to gauge, well, when you had the lockdown, what did that do to your financial outcomes? So when we're looking at, and the OECD has released to look at, well, when you're looking at the comparable companies, you can also use other contemporaneous information to support, whilst you may not have achieved the same overall result, you're still operating at arm's length. Now, some of that may be information such as changes in sales volumes. So for those businesses that were shut down, for example, for the 2 months, their sales are going to drop. They will still have fixed costs. Now, that's going to impact their overall financial outcome. Any incremental or exceptional costs. So there's been a lot of additional costs that businesses have had to incur as a result of COVID, whether it be, extra cleaning and a lot of other costs that really are going to be, a lot higher than we would have expected as far as when the benchmarking was performed. Some of the government assistance, and I'll go through that in a bit more detail later on, but the government assistance that's come through, some of the overall macroeconomic trends that you've actually been seeing, I talked about even the states as well. Budget versus actual data. So what happened with your budget? And there are, in a sense, maybe fixed costs that we're not going to have the revenue and therefore the gross margin that we're going to be able to contribute across those fixed costs. And then an analysis of the effects of the profitability or basically the third party behavior around that. So what the OECD is really saying here is that we understand that when you're undertaking the comparability analysis, we're going to have to look at not just the financial outcomes that potentially come out of a database and comparing them to yours, but also what are the other factors that you may have had. And these are some of the factors that they're looking at as accepting to be able to justify that despite not achieving potentially on that comparable range potentially, what are some of the reasons and how can you justify that you're at arm's length? So another part that they were looking at was also in regards to the timing and what relevance the timing issues are going to be around all of this. Now, the most reliable information to use is contemporaneous, what we call contemporaneous uncontrolled transactions. Now, this is often found in the databases that we use, so the third-party databases. So looking at some of those public databases and then the availability of the information that goes into those public databases. So constantly what I'm going to find as I'm going through, since this presentation, I'll be constantly referring you back. So even after today, when you're going through with your company, go back to the slide that I just talked about, some of those contemporaneous sources that you might look at. You're going to be constantly going back to those sources to really build what are the commercial, how can you justify your financial outcomes from a commercial perspective? What are the factors that have happened? And so depending on the information that's coming through from the public databases, we may actually have, from a timing perspective, whether we're going to have all the relevant information coming in at that time. The most notable when it's going to be an issue from a timing perspective is really in the application of the transfer pricing method called the transactional net margin method. So many of you may use the transactional net margin method where we're looking at it, and it's a profit-based method. The 2020 financial information typically is not going to be available until mid-2021. But we're in 2021 now, and a lot of my clients are saying, well, actually, I want to know what margins should I be using in my current year. For example, actually, even in starting at the beginning of last year, you may have been using the financial information from 2019 to set your pricing for 2020. Now, January, February, and March, that may have been okay, but come towards further in March, that may not have been okay from a timing perspective. So that's where, when you're looking at the comparability analysis, you may have been applying throughout the year those ranges that you agreed at the beginning of the year, the margins that you agreed at the beginning of the year, but come through the whole year in COVID, the overall financial outcomes that you've actually resulted in coming through to the end of the year may not be comparable when we're looking at those particular aspects. So the timing, I suspect there will be some, going back to my initial slide, also on the contemporaneous source information, but also the timing will be something that we'll be wanting to have a look at, and making sure that we're comparing financial data that is related to the time in which we're trying to test, in a sense, the financial data for the client at this time. You are going to come across when you're going to have some information deficiencies. Now, I say that could be related to so trying to get information from looking at the comparability perspective, and what the OECD is saying is that they are going to accept reasonable commercial judgment. So the theme that you're going to see coming through everything that I'm talking about today is we're really coming down to, well, what would independent parties do in a real commercial situation, and how can you, from a commercial perspective, justify the financial outcomes that you've experienced despite going through COVID? Why are these commercially acceptable and not a case of achieving a transfer pricing benefit in either location? There could be some looking at then the best market evidence that's currently available. What do we have? Do we have any internal comparables? Did you have any potential agreements with independent parties that you may have negotiated? So let's just say you're a multinational and you have related party distributors in many countries, but you also have a few independent distributors in some countries. Did you, as a result of COVID, enter into any other negotiations with those independent distributors? They approached you to renegotiate during this COVID period. And if so, do we have any internal comparables that we may be able to support the changes that you've gone through, or the financial outcomes, or any other relevant evidence of some of the economic impact from COVID perspective? The other one is looking at going through and looking at a real outcome testing approach. So allow for the arm's length outcome testing. So we're getting to the overall financial outcome and really being able to have a look at what is that overall financial outcome? Are there any other adjustments or tax adjustments that need to happen? And how does that overall outcome compare? Even though you may have been implementing transfer pricing throughout the year, how does that overall testing, when we get to the end of the year, what does that outcome look like? And is the overall outcome at an arm's length, and are we able to support that from an arm's length perspective? So some of the other areas that the OECD went in a bit further detail also in having a look at this is the use of, in a sense, TP, the transfer pricing method that you may be using, and also multiple year data. There was a suggestion on the use of more than one transfer pricing method in being able to test your financial outcomes, and then potentially looking at multiple year data. Now, I personally do kind of frequently use more than one transfer pricing method. Now, when I do that, if I perform a comparable search and I've performed the search, but I'm not, there's other aspects that I want to look at, I might be using a secondary method as well to further support the financial outcome of what I've achieved. I think this is going to become really important during this COVID period, because we may have perform the benchmarking and have the comparable search for a certain part of the transaction, but we need to come in and also perform, in a sense, I guess you would say, it's nearly like that second sanity check on looking at the overall financial outcome. So there may be a situation where you may need to use more than one transfer pricing method. Now, in general, the OECD recommends that you use what they call the most appropriate method. So you will apply the most appropriate method, but you may need a secondary method to support that as well. And you may want to have a look at using multiple year data rather than just 1 year data. Now, what's interesting about the multiple year data, when I look back to the GFC, which now makes me feel a bit old because it was actually quite a long time ago now when I look back to basically 2008, 2009. Now, prior to 2008, when we reviewed your financial outcomes and looked at the financial outcomes, whilst we may have had the last 5 years, so in Australia, we look at 5 years worth of the comparable companies, rest of the world tend to use 3 years. When we would actually look at from an arm's length perspective, we'd always look at the weighted average over the 5 years. Now, the reason for this weighted average over a number of years is what we're trying to look at from a transfer pricing perspective is to see that, you know, one business may be in a certain part of their business cycle, the next one's in, say, the year two of that part of the cycle, year 3. And so the 5 years basically enables you to get a weighting across all of those years. What we all learned from the GFC was the focus changed, that we were looking at not just multiple years, but we were also looking at that 1 year. So we were looking at, say, 2008 compared to 2008, in addition to looking at it on a weighted average over the past 5 years or 3 years, depending on the country that you were looking at. That approach, and we implemented that in 2008, 2009 because of the GFC, and because some businesses were impacted in different parts of the world, in different industries and different supply chains at different times. It wasn't something that happened just in that October to December in 2008. Some didn't feel the impact of it till later. So we looked at it on a year-on-year basis, but also compared that to the weighted average as well. That approach on transfer pricing just has continued since 2008. So when we do your transfer pricing analysis, you'll often see that the advisor will actually say that your arm's length, your outcome was within the arm's length range for not only then that year, but also the prior years. I think there's going to be more focus on both of those aspects now as a result of what we're going through with COVID. I'm even looking at it, when I say even we look at the multi-year data, I know what from my perspective, I will also, and going back to those other sources of information, I'll be probably segmenting a lot of the client's financials even out to quarterly before I roll it up onto an annual basis to really see if I can pinpoint the COVID impacts, because some of the COVID impacts in various countries have happened at different periods and for shorter periods of time as well. So those two areas, just to summarize, go back, you might have a look at separate testing periods to take into account the impact of COVID. Make sure you're comparing the same, in a sense, testing periods that you're looking at. Take into consideration also any government intervention and make adjustments for that. It is going to be interesting to see how much of that information is going to be readily available in the financial statements that we're going to be getting, to be able to see some of that, those to be able to make some of those adjustments. And then I guess determine on a case-by-case basis the extent to which these adjustments are going to be necessary and when they're going to be required. The OECD also talks about potentially the price adjustments, and they also touched on the existing comparable set. So would a price adjustment mechanism be appropriate? Is that going to, and what actions might be taken to evaluate a set of comparable companies and transactions to use? So you're looking constantly through all of this, is do we need to make an adjustment? So if you've had a company throughout 2020, and let's assume a 31 December 2020 year end, you've got a company who has been implementing their transfer pricing. It's set each year. It's been, it was decided in January of 2020. Pre-COVID, they set it for the whole year. We get to the end of the financial year, and we're now trying to look at whether this is actually an arm's length outcome. The OECD are actually presenting that it should be possible for those parties to the, I guess, the OECD, but countries to be able to make those adjustments in a later period and bring them back if that's going to make the information so that they can adjust those transfer prices that they may have implemented during the year, if in fact that's going to make it more of a consistent financial outcome with what it should be from an arm's length perspective. It is very important to make sure though that you do consider the appropriate characterization of any TP adjustments that you may do and the impact on that adjustment, what that might do to the 2021. So it's something that's definitely to make sure that you keep an eye on that. The other one is to look at how do we evaluate an existing set of comparables. Now it has been highlighted that when rolling forward your existing comparables from to cover 2020 and you bring these forward, you do need to go through, similar to what we do each year when we are updating your comparables. It's not a matter of just updating the financial information. You do need to look at those comparable companies and make sure, are they actually still comparable? Is that geographic comparability still relevant? Now, there will be situations where you may have used in a particular transaction, and I can use Australia as an example, you may have actually decided that the US was a very comparable market for this specific transaction that you're testing. Is that still going to be the case given that what they've experienced with COVID over the last 12 months? So that's going to depend on the industry that you're in, but you do need to have a look at the comparable companies that you do have in your benchmarking now and actually decide and kind of reevaluate, are each of those companies still comparable, and go through each of the comparability factors to make sure they're still relevant rather than just updating the financial outcomes and seeing with you whether you fall within those ranges as well. So loss-making comparables. Now this was another, I would say, kind of hot topic back with the GFC as well. Now, a lot of people believe that tax authorities won't accept loss-making comparables. I guess the OECD and the majority of tax authorities, they will accept them, but the expectation is that if you have independent parties, you wouldn't expect that they would actually be having a loss making for a long period of time. Now, what we learned in the GFC, I would have seen during that period of the GFC, the most flexibility that I've actually experienced with any tax authorities at that point, the ATO and also the US, in accepting loss-making companies, because that was normal business when we were going through that GFC. I suspect that is going to also be this situation, and this is what the OECD has actually said, that they do recommend that tax authorities and do accept that the loss-making companies may actually, if they satisfy the comparability criteria, loss-making in this market at this time could very well be reflective of what the financial outcomes could be for those particular companies. So it's always important to focus on the comparability factors, making sure that they are comparable, and also looking at the industry as well. So there is no, as I said, overriding rule on the inclusion or exclusion of the loss-making companies. Ultimately, if they're comparable, if they've continued loss-making, you'd want to question what I guess the viability of that company and why they're continuing to be loss-making. Often when we have that situation, we'll research further into the company, understand their financials, and try and identify what is it that's triggering and whether there should be any other adjustments made. But yeah, loss-making comparable companies can be included, provided that you've got all of your other comparability factors satisfied on that. So what about when we have situations with losses across the board? What if everyone's in loss across the board and we have all of these allocation of COVID-19 specific costs that all of a sudden head office wants to share all of these costs across the board? Taxpayers is really going to need to look at, and this is going back literally to, I'd call it transfer pricing 101. You're really going to have to go back to your functions, your assets, your risks, and where all of those are within the organisation, so that you really can have a look at, well, where should those losses be? The other, also you need to consider what are those allocation of the COVID-19 specific costs? What are those exceptional non-recurring operating costs that have arisen as a result of COVID-19 and where should they potentially go. So I'll go through those in a bit more detail. One of those which we're getting a lot of questions on is limited risk arrangements, or if that's a multinational, like a subsidiary here in Australia. So they've got a, let's just say a US parent, they've got a subsidiary here. They buy products. The products could come in from, China. They could come in from any different location, or purchased from related parties, and they sell it here in Australia as a distributor. And at the moment, they were shut down for 3 months. Let's just say in Melbourne, they were shut down for 3 months. They couldn't operate. They still had fixed costs. They still had to pay some of their wages. They still had to pay the rent. And all of a sudden you find yourself that they are actually in a loss for the year, but we've actually said they're a limited risk distributor. How can they actually incur losses? So in going through and looking at that, and this is where I suspect when I go through this with a lot of clients, I think I'm going to be going down to even getting your quarterly P&L, maybe even the monthly P&L, to really kind of break it down and see if I can pinpoint the, I guess, the COVID-19 impacts. You said you were closed down in those months, so that your overall, let's just say the overall financial outcome for the year may be a loss, but the losses you may actually have an arm's length outcome in January and in February. March was, down a little bit as you got, shut a bit. When we opened back up again in Melbourne in June, maybe it peaked back up, and then the 2 to 3 months that we were all locked down. So it's really going to be, with a limited risk arrangement, it's really going to be that, yes, you may accept losses, and this has always been the case. Simple or low risk functions can actually potentially make a loss if they don't get enough volume of sales to achieve the gross margin that's able to pay those expenses. So you can make a loss as a limited risk distributor. It's obviously not expected, and you wouldn't expect it to generate for a long period of time. So it's really going to come down to actually the facts and circumstances, and really trying to dig in and say, well, why was it that the distributor made a loss? Was it, and if you go back to my source, contemporaneous source information, what was our budget for 2020 pre-knowing about COVID? How was that budget impacted? On the expenses, what expenses did I have? What was I able to reduce when I got shut down? So you're really trying to show that there was no incorrect transfer pricing. It was actually COVID that's impacted in that situation. You also want to look at the risks that have been assumed by the limited risk distributor, and how much of that, if the inventory risk has always been taken by the parent, that's something that shouldn't be a risk for the local distributor. But it's really going back to, I guess I'll call it a bit TP 101, going back to the framework of actually having a look at what were the actual risks over here, and how has that impacted the financial outcome. So the limited risk arrangements, I think, is something that's going to need a lot further work if you don't fall within the range, which I suspect many will have suffered the financial outcome of it. But I think that it's going to need a bit more work down to whether it be quarterly or monthly to be able to justify those outcomes overall. What about those allocations? Sorry?
Sorry to interrupt, Sharon. Yep. We've got a question from Chris related to risk allocation. I think that will be relevant to the thing you're talking about. So the question Chris raised is, the guidance highlights one of the issues, how how losses are to be allocated, and whether or not there has been a change in intercompany relation and risk allocation from prior years that needs review. And do you think that this is a major focus point moving forward?
Yeah, I think that definitely will be something that they will be focusing on. The OECD and the ATO, and we chatted when JobKeeper and the cash boost was first announced. We did contact actually the ATO and to speak with their transfer pricing team, just to make sure that the those that decided on the cash boost and JobKeeper were speaking to the transfer pricing side, because I did see that aspect. And when we were speaking with them, it was really focusing on what they want to focus on is making sure that there haven't been any changes in the risk profile, or whether it be intercompany agreements, or whether the actual changing in making them adopt risk, because their fear is that when we have this kind of, I guess, downturn and this slowdown, their fear is that companies will use this as an excuse of pushing a lot of those expenses out to the different areas, making them assume risk that actually, if it's not in the contract, if they weren't actually going to be getting the risk, and one of those might be even going back to a service provider, that if they're a cost plus service provider, despite the fact that their services may have reduced, if they're a cost plus service provider, they should still be getting the cost plus on their relevant service being provided. So I do think that there will be a focus on the making sure that there hasn't been any changes in the relationships between the related parties that have been changed for the purpose of kind of, I guess, looking at a transfer pricing benefit that could be achieved from those parties, but making sure that you've actually looked at it from a risk perspective. And what do your contracts say? What have your contracts said? What have you always done? And making sure there's that consistency as well on it. Yeah. Okay. So did that cover that one? Did you have something, Adriana?
Yeah, may I just comment? I think I agree with you on all the points. I think one thing that we have seen in Asia is some questions along the lines of who was able to make the decisions to mitigate the COVID-19 risk. So I think some evidence around that could also help to give substance to the potential assumption of COVID-related 19 expenses in a loss situation.
Yeah, that's a really good point. Yeah, that's a really good, because that needs to be, and there will be at a higher level some evidence of that. But yeah, that's definitely that's a really good point. The allocation of the operational and or exceptional costs. Now, we've had a few clients contact us because they've had foreign parent companies wanting to shift as much costs as they can over. And it's really having a look at going back to the commercial reasons and being able to justify it. Again, functions, assets and risk, but also looking at, well, what are these costs and how would they be in a sense allocated amongst independent parties, understanding that some of these costs, will not always happen with independent parties. What are the risk assumptions? How would third parties treat such costs? So situations, I look at that with some of the extra requirements around COVID that makes it more expensive to maybe deliver on a particular service in an independent party situation. Would you renegotiate if you were providing that service and now all of a sudden you actually had other requirements because of COVID? Would you renegotiate with your client on that to provide that service because of these extra requirements that were not known at the time that you entered into the agreement? So it's really looking at, well, what are those exceptional costs? And what would independent parties doing? Now, there's no absolute, I guess, rule of thumb with a lot of this, and it's really coming down to being able to justify and show that this is what third parties would be willing to negotiate and how they would come up with that. And as Adriana said, well, how were they allocating and what was the decision making behind the COVID-19 costs and why as well. And then looking at some of those operating costs that relate to long-term permanent changes in the business. Some of this, I've seen a decent number of manufacturers coming back to Australia. They've had huge problems with their supply chain. I think we all saw it with the banks. I think their offshore centres did not work that well for them during the COVID period, and a lot of them looking to bring some of their services back here. So having a look at some of how of these kind of costs are then allocated as well, and being able to have, I guess, commercial reasons for the way in which you've allocated. It can't be something where you're just allocating the loss of the business. Again, coming back to the question we had on the risk, we can't just allocate all these costs throughout the business if we have an entity that actually has quite a low risk profile and in an independent party situation wouldn't be expected to take on that risk. So it is definitely something that I would recommend going through each of those, say, costs and allocating them, making sure you've got the full story behind them and working out so you've got support as to how you're going to be allocating those costs as well and why it's commercial to do so in that way. Also looking at a lot of your force majeure clauses, there was a bit of talk, and I think the ATO was very quick on this when I was speaking to them on it, is that they didn't want a situation where all of a sudden related parties would change their legal agreements or just enter into different agreements all because of COVID. Go back to your legal agreements. I mean, you know, as an accountant background in transfer pricing, and then you have the lawyers, when it gets to the courts, it's all going to go back to the legal agreement. So it's really coming down to, do you actually have the ability to make any changes in your legal agreements? Or is this something that we don't have that ability to change? And it all comes back to, what would you do in an arm's length situation? What would you expect if it was two independent parties operating? So definitely don't just assume because we're related parties, we're going to change our transactions because, or change the pricing or change some of the terms because of COVID. You do need to go back and look at your agreements, and also work out, well, what would independent parties undertake? What would they agree on? And maybe it's then having a look and going through as a variation of the agreement during this period of time. So the OECD has also touched on the government assistance programs as well, whether it be monetary or non-monetary. But how does that impact the transfer pricing aspects, and especially on the comparables? Now, a lot of that, I guess when we look at some of that, when we're looking at the controlled transactions and having a look, is what we need to have a look at is the receipt of the government assistance an economically relevant characteristic? So we need to consider, well, what was the government assistance that was received? We look at it in Australia, we look at the cash boost and the JobKeeper. What was some of the nature of that government assistance? It is going to be, I say interesting is probably the interesting word for it, of how we're going to get some of that data for the different foreign countries and what the reporting requirements are going to be around that. And so we need to look at, well, what are the characteristics of it? What was the availability? What was the purpose of it? What was the duration? And the whole time what you're trying to look at is, and therefore is, what's the financial impact on these companies that may impact our transfer pricing. Now, one thing that was very clear from the ATO when we spoke to them is, if the Australian government is giving out government incentives, they included foreign companies as well, but they didn't want that money then to be taken out and gone, in a sense, as part of the transfer pricing adjustments in going through. If the government assistance is an economically relevant characteristic, like the fact that you have the government assistance, it does have the financial impact, it's relevant to the transaction, then the information should be included in the TP documentation as well. And then looking at, does the receipt of the government assistance affect the price of the controlled transaction? So this goes back to, again, trying to compare the economic, the characteristics of the transaction, trying to look at when you're trying to compare apples to apples, and looking at the comparability analysis, and whether that, you know, is it taxable, not taxable, or how should that adjustment be to be made. You will need to do further analysis because of these government assistance programs that we've got. Coming into the comparability analysis, which I think is going to be the major impact on it, is you are going to need to have a look at it. And if I look at, say, the JobKeeper, you are going to need to have a look at it. In Australia, what we're tending to see with the financials that I've seen so far is that it has been separately identified in the financials, but that's going to be something that you will need to look at the government, when you're looking at comparable companies and seeing what entities actually receive some of these government incentives. Look at it also from the same and comparable geographic market and how that might impact it. And you may need to look at revising your comparable strategy, and that may go back to looking at that other method to be able to say, well, because of the method we were using originally, because of that, maybe be the government incentives, we're looking at the comparable data. It may not, we may need to do a secondary method to try and support the overall outcome and justify the comparability of it. We will also need to take into consideration the accounting treatment of the government assistance and seeing how that comes out in the financial side of it as well. So you're really coming back to looking at the companies, obviously the independent comparable companies, looking at your functions, your risks, your assets, but we are going to be having to look in a bit more detail of all of the, I guess, the annual reports of those comparable companies to make sure that we can dissect and adjust, if applicable, some of these government incentives that may be in their financials that we have as well. Just to touch briefly on advance pricing agreements. So did you have something, Kevin? Do you have
yes, we've got another question from Justin.
Yeah.
Now this is sort of about take IKEA Australia, for example. During the COVID, they have a profit increase of about 11% in revenue, top level, but they make a loss for the 2020 financial year. So obviously there's a lot of costs imported to Australia.
Mm-hmm.
Now the question is, would the ATO look at profit similar at a similar IKEA store globally, or is it always comparable to third-party retail?
So it's similar to the parent. Sorry, what was that one? So
the question is, would ATO look at the profit as similar IKEA store globally, potentially as a comparable, or would it look at a third-party retailer?
You'd be looking, I guess, looking more at, well, making sure that it looks from an independent party. And why is it that if you've had the gross increase, but you've got, so what is the question saying that they've got more extra costs that have come through, more expenses?
Yeah, because the person says like there's an increase in revenue, but
yep.
you end up ending up in a loss-making position.
Yeah, so you'd still want to have a look if you've had an increase in revenue. So going back to that source, the source information that the contemporaneous information. So if you've had an increase in revenue, what you'd be wanting to have a look at, well, why did you have an increase in revenue? What was your margin? So what was the margins that was driving that? Were you able to, was it down to units? If you're looking at, was it the volume of, and you were able to charge more because all of a sudden no one else could get, what did bikes sold out? No one could get bikes. So all of a sudden bikes were selling for a lot more. Were you able to charge a higher price point? So what was the driving of the revenue? And then why did you not make the additional extra profits? Now, was that because you drove the revenue, but you had a lot of additional expenses to be able to drive that revenue because of the COVID situation? So you'd really need to be able to dissect that, and it's really having a look at that compared to, well, what would comparable companies, so independent parties, be looking at achieving. It's with the loss, you might still look at the parent entity on what the overall outcome is, but it still comes down to what the entity here in Australia has as far as assets, the functions, assets and risks that they have here in Australia, as well as looking at, and I touched on earlier about the losses. It's not just about allocating losses across the board to all the different, the parent and the subsidiaries. Where's the risk? So that entity, I'd be wanting to understand a bit more. If they've driven sales up, why do they have the loss? And was that extra COVID costs that were incurred to be able to make those sales that they had?
Yeah,
so probably just needs to be dissected. Did that answer the question there, Kevin?
Yeah, I see. Thank you. Yeah, I think that to add to your point, I think this is very, very good a point. Instead of looking at just the global IKEA store profit,
yeah,
we should also look at what is the local market doing, local market furniture retailer, because it ties back to what we have spoken earlier just now, where you have government assistance program that is specific to your country. And then later on, we will touch on about some tax concession incentive that would allow taxpayer to claim certain deductions that were not available in certain countries. So that might contribute to the loss-making position as well. So we really have to just look at first geographic circumstances, whether or not there's a special market environment that is in Australia and it's a bit different from overseas country. So always we will look at the geographic location first, and then we'll see whether or not we need to have also look at put some consideration into what is the global market doing.
Yeah. So looking at your existing, those of you that might have existing APAs in place, so you've got this agreement with the tax authority, what the OECD has actually said is talking about that the terms actually should be maintained unless there's a breach of the critical assumptions. So this is something to really, just because, and then what they're saying is a mere change in the business results because of COVID does actually not mean that there's a breach of the critical assumptions within the APA. So when you're looking at it, that you can have this financial impact of COVID on the entity, but it doesn't mean that you're going to be in breach of the APA. And so I guess with the OECD guidance, for those who are not aware, that the OECD guidance is out there to guide taxpayers, but also to guide tax authorities as well. And so what they're really looking at is trying to, I guess, stress that the financial outcomes of a COVID-19 situation doesn't mean that the business locally, the entity has actually breached the APA. So it's really going back to what your requirements are. If you have breached the APA, so let's just say the margins that have resulted in the local country are significantly lower, even if they are they're lower because of the COVID situation, but they are significantly lower, and it isn't something that's going to be adjusted for, then you may want to actually go back and have a look and assess the terms and agreements and consider even revising, cancelling, or even revoking it, depending on the situation as well. So that's something that's going to be quite specific if you have a look at the agreement that you've got in place, and then looking at the financial outcomes and seeing how you can justify the different financial outcomes that have come through on the entity. If you're under negotiation with for an APA at the moment, I guess I'd really try and adopt a flexible and collaborative approach to this. You might want to consider a short period APA. COVID didn't just come and go in a few months as we all kind of expected. By June last year, we thought we're all okay again. It could be something that's going on. So you may actually want to have a look at a short period APA given the impact and what's going on in the future. You maybe want to take into account respective amendments to the APA, or you may just want to extend the period. So if you're in that process at the moment is what they're suggesting from an OECD perspective. So looking at it from the Australian side, now a lot of what came out in the OECD, I'm sure the OECD looked at what Australia had published, because I know Australia can be quite influential within a lot of that. There's nothing controversial that came out of the OECD guidance that would be controversial for the ATO, but the ATO were very quick to get out guidance in relation to this. We were really pleased to be chatting with them literally just as the JobKeeper came out, to really bounce some ideas with them and really understand what was going to be their view or focus as a result of this, and were they going to be coming out with guidance. And at that time when we spoke to them, they said they were going to be looking at that, at bringing that out. So they released their guidance back in June of last year, which was critical because obviously we had a lot of the economic stimulus impacts that came in for a lot of companies, 30th of June financial impact as well. So the main focus that we were looking at from an ATO perspective, the kind of concern that they had, and I guess this was touched on a bit earlier with the question that we had on the risks that were coming through, but they issued two guidances. One was on the economic impacts of transfer pricing arrangements, and the other one was looking at changing related party agreements in the COVID-19 situation and being able to support those changes if you do have changes in those changes in your related party agreements, and would that be what arm's length parties we're looking at. So let me just go through just a few of those in a few more. So some of the economic impacts that they were looking at was really, and I guess everything that they were talking about, similar to when we had the discussion early, and what came out is the ATO just wants to know what is the financial outcomes. If the financial outcomes are not consistent with the comparable companies, are there reasons for commercial reasons, so not transfer pricing, not changes to achieve transfer pricing benefits, but are there reasons to support why those prices were actually not coming out consistent with the comparable parties. So looking at things like looking at the businesses overall, if they come in and have a chat with you, they'll look at the overall TP compliance, look at the business profit that's been impacted by COVID, what were the functions, assets and risks pre-COVID, and what happened with the functions, assets and risks during COVID and even post-COVID as well. What was some of the industry analysis on the COVID impact? So if looking at what happened in the wider industry and in any evidence that you might have on changes in your product or service offering that you may have had during that COVID situation, and evidence in changes of business strategy due to COVID and changes in TP arrangements during that time, so that it can actually, so that you can actually justify what your financial outcomes were at that particular time as well. So supporting the arm's length nature of the transfer pricing outcomes. What's the impact on the risk assessment for inbound distributors? So PCG 2019-1 enables you to step through if you're an inbound distributor, so you're a foreign subsidiary here in Australia, it enables you to step through to understand your risk assessment in the eyes of the ATO. Based on your characteristics. So you go through that risk assessment. Now the ATO has actually said that they're not going to update the profit markers for the COVID impact in that PCG, but so you might still come out with a higher risk than you would normally because maybe the financial outcomes are not as great as you were pre-COVID, but you're going to need to have your commercial factors. So think about some of those other factors I talked about earlier. With the APA process, the ATO have said that they'll still honour their commitment to work on the APA applications. For existing APAs, they need to review the impact, and they want taxpayers to proactively engage with them. And the whole dialogue that we've had with them when they're, I guess, putting this guidance together, and even when that was then released, is they're really saying, well, look, at the end of the day, we want to understand what has been the financial impact, the economic impact on the company as a result of COVID, and we need to be able to support that. They don't want to see that there's a situation of, as I was saying, related party agreements being changed because of the COVID environments. And if you are changing that, would independent parties mutually agree to those changes, the new terms and conditions, making sure that there's still consistency, there's no mismatch between the substance and the form, and what are the purposes of the change to the arrangements, and are the changes put in place in the are changes put in place with the anticipation of a potential review from the ATO, making sure that everything that you're looking at doing is really coming back to the commercial factors, and that you're being able to justify the operational sides of it. What we did see, and this is just some other Australian tax considerations that this is just to focus on and might be side issues for other transactions, especially for those of you that are the finance and tax manager that might often be the last to know about these things within the company, but is to have a think about with this limitless write-off of all assets purchased and used before June 2022, a lot of companies are eligible for that. There will be a significant amount of companies maybe investing in further equipment. What other transfer pricing transactions may that trigger? Now, one thing that I would actually see is probably the funding on that, and needing to fund the purchase of that equipment. And will that funding be actually through related parties, or will it be obviously independent parties is not going to be an issue, but just to keep an eye out on how that may be funded, and whether you may actually find yourself having some additional intercompany agreements. So if you do see the company having plans for some major asset, now's the time for a lot of them to upgrade, and I've heard different companies talking about really having some major investment in upgrading, just looking at how that's going to be funded, and if that's going to be through a related party, and that potentially was going to trigger a related party loan coming through as well. Also, keep your eye out on the JobKeeper and the cash boost and the implications of that to make sure that those aspects are taken into consideration, that don't just get grouped up when you're looking at your overall financial analysis as well. So I guess some of the top tips we wanted you to take away from this, I think the overall theme that we are seeing is that the OECD, the ATO, you know, their overall message is, you know, if your profitability isn't consistent with what maybe the independent parties may have achieved. I mean, firstly, are the independent parties still comparable? But also being able to justify from a commercial perspective that your financial outcomes have not been impacted by transfer pricing, it's been impacted by COVID-19, and being able to support and answer those particular questions. So going back to one of my initial slides, looking at the sources of information. So when we're looking at the transfer pricing analysis, we're not going to be just looking at the financial statements. There's going to be a lot more work this year and being able to really dig to the detail behind a lot of the expenses. So recommend you put your robust documentation in place, speak to some of your operational management, review your COVID-19 impact on the functional profile. What's changed? Are you changing your business strategy? Because there's been some amazing changes in some of the strategies. What does that do from when we look at your overall financial outcomes? Review and document any of the commercial reasons driving some of the changes that you might have in your intercompany contracts. Look at enhancing your economic analysis, particularly if you're loss making, to support your arm's length outcome. So the question we had earlier, I'd be really wanting to dig down into the detail. Yes, you had greater sales. What triggered the loss? Was it additional shipping costs? What was it that triggered the loss relative to, and I know I bought from the company over the lockdown as well, and they delivered and they charged me $30 for delivery. So normally they may have charged a lot more. So what really triggered that loss, even though you had the extra sale that came through? Reassess your comparables and search criteria. Is it still relevant? Are the comparables still relevant? Analyze the treatment of the government assistance. And then, you know, if there are any challenges or issues around your APA, I think it's better be on the front foot and have those open dialogues with the tax authorities up front, so you can really address those. So that's kind of come through, I guess, to try and cover through what's going on with from the OECD. We have, and also on the ATO, we have put some blogs up on our website, especially in particular to JobKeeper and how to account for those. But if you've got any questions at all, please don't hesitate to make contact. We will be running a few more webinars this year. If you've got any topics that do interest you, please don't hesitate to let us know. Did we have any other questions coming through, Kevin, at all? No other questions. Yeah. Maybe we answered everyone's questions, I hope. If you do have any other questions, please let us know, and I'm happy to have a chat with you. But thanks so much for joining us today, and I hope you found it beneficial in getting yourself ready for your end of year transfer pricing. Thanks very much, everyone. I hope you have a great year. I hope 2021's a better year than what we all had last year. So thank you.